In this video, we're going to talk about the concept of investing in bonds. We're going to talk about how to calculate the current yield, how to calculate the total price paid for a bond, how to calculate the amount of interest that you expect to receive semi-annually, and also the return on investment, as well as the yield to maturity. So we're going to calculate a lot of things in this video. So let's start with this problem. John buys 10 corporate bonds with a face value of $1,000 each. The coupon rate is 7 and the payment frequency is semi-annual. The maturity date is 30 years from now. How much money will John receive every 6 months? Well, first we need to know what is a bond. A bond is basically a debt instrument or a debt security. The investor who buys the bond loans his money to the issuer. The issuer could be a corporation, like in this example, since we're dealing with corporate bonds. It could be a municipality. It could be the government. Whoever's issuing the bonds, they're the ones who are borrowing the money from the investor. So John is buying 10 corporate bonds with a face value of $1,000 each. So he's lending $10,000 of his money. So that's his investment. So his bank account is going to go down by $10,000. Now we want to know how much money will John receive every 6 months. The coupon rate for the bond is 7. So that means that 7% of his investment will be paid to him every year. So he invested $10,000, and if we multiply that by 7%, which is 0.07 as the decimal, you can get that number by taking 7 and dividing it by 100. His annual payment is $700 in interest. Now, most bonds have a payment frequency that is semi-annual. So he's going to receive 2 payments of $350 each. Simply take this number and divide by 2. So this is the answer for part A. That's going to be how much money he's going to receive every 6 months in interest payments. Now let's move on to part B. What is John's ROI, or return on investment, after 30 years? In order to answer that question, we need to calculate the total amount of money that he's going to receive in the course of 30 years until the bond matures. Now, every year he's going to receive $700 in interest payments. And this is going to happen for 30 years, assuming the corporation doesn't go bankrupt, in which case he may lose a part or even all of his investment. So what is 30 times 700? 7 times 3 is 21. And then all we need to do is add the 3 zeros. So 700 times 30 is 21,000. Now, at the end of 30 years, the company is going to give John his principal back. So he received 21,000 in interest payments, and his original $10,000 principal is going to be returned back to him. So he's going to receive a total of $31,000 in the course of 30 years. So now let's calculate the net gain. So his bank account decreased by $10,000 when he first invested in this bond, but over 30 years it's going to increase by $31,000. So his net gain in this case is basically the interest payments that he received, which is $21,000. Now, to calculate the ROI, it's going to be his net gain or profit, which is $21,000, divided by the cost of investment, which was $10,000, times 100%. So his ROI after 30 years is only 210%. It's pretty low, but bonds are less riskier than stocks. So you do get a lower ROI, but nevertheless, there's more safety when investing in bonds. So that's the answer for part B. That's his return on investment after 30 years. Now, one thing that is important to understand is the time value of money. The $700 that he receives in interest payments in the first year is worth a lot more than the $700 that he's going to receive 30 years from now. $100 now can buy a lot more than $100 30 years from now. So just keep that in mind. Each interest payment that he receives doesn't have the same value because the value of money tends to decrease over time due to inflation. But we're not going to take into account the time value of money in this example problem, just to keep things simple. Now let's move on to our next problem. Morgan buys 15 tax-free municipal bonds at a premium of $105.42. The coupon rate is 5.25 and the payment frequency is semi-annual. Part A. What is the total price or principal that Morgan paid for the 15 bonds? And keep in mind, one bond has a face value of $1,000. Now typically when buying bonds, even though one bond is equal to 1,000, you're quoted at a price that is slightly above or below 100. If it's above 100, you're paying a premium. If it's below 100, you're paying at a discount. Now, to get the actual price of one bond, you need to multiply this by 10. So the price of one bond in actuality will be $1,054.20. Now Morgan is going to buy 15 of these, and these are tax-free municipal bonds, which means that the interest payments that he received from these bonds is not included in his taxable income. He doesn't pay any taxes on those interest payments, which is nice. That's the one way you can make money without paying taxes. So let's multiply 15 by 1054.20. And so the total price that he's going to pay for these 15 bonds is $15,813. So that's the answer for part A. Now, let's move on to part B. How much money will Morgan receive every 6 months in interest payments? So now the coupon rate that he's going to receive will be based on the face value and not necessarily the premium that he paid. So he bought 15 bonds with a face value of $1,000. So the total face value of these 15 bonds is $15,000. Now he paid more than what the issuer sold the bonds for. The issuer sold it at $15,000, but when he paid it, he probably bought it from another investor at $15,813. And bonds, they can fluctuate in price. They can be more than what the issuer sold the bond for, or they can be less, depending on what the interest rates are at the time. As interest rates go up, bonds go down in value. And as interest rates go down, bonds go up in value. And so there's an inverse relationship between bonds and the prevailing interest rates. But now let's continue with part B. So this is the total face value of the 15 bonds when they were issued. And now the coupon rate is 5.25%. So if we multiply that by 0.0525, so that's the percentage as a decimal. So what you can do is move the decimal point 2 units to the left, and you get 0.0525, or just divide this number by 100 to convert it to a decimal instead of a percentage. So 5.25% of 15,000 is $787.50. So this is how much he's going to receive in interest payments for the whole year. But he's going to be paid twice per year, semi-annually. So we need to divide this by 2. So his semi-annual interest payments will be $393.75. So this is the answer to part B. Now what about part C? Calculate the current yield of the bond. How can we do that? To get the current yield of a bond, you need to take the income that you receive in interest on an annual basis and divide it by the price that you paid for the bond, or the current price of the bond. So the annual income that we're receiving from this bond, or rather that Morgan is receiving from the bond, is $787.50 in interest for the whole year. Now the price that he paid for the bond, well, the total price, and I had to erase it, that was 1054.20 times 15. So the total price that he paid for the bond is $15,813. And we're going to multiply this by 100%. So the answer is 4.98%. So that is the current yield of the bond. Now, another way in which you can get the same answer, rather a much easier way, is to take the coupon rate, which is basically the interest payments with respect to the bond at its original price. So you take the coupon rate and divide it by the current price of the bond. So the coupon rate is $5.25 per $100 of the original bond price, and divided by the current bond price, which is $105.42 times 100%. So this will give you the same answer. If you plug it in, you'll get 4.98%. So those are 2 ways in which you can calculate the current yield of a bond. Now let's move on to part D. Calculate Morgan's ROI if he holds the bond for 30 years to maturity. So he paid $15,813 for this bond. Every year he's going to receive $787.50, and then this is going to be for 30 years, assuming that the municipality doesn't default on the bond. And so he's going to receive $23,625 in interest payments. Now, at maturity, that is when the bond matures 30 years from now, the issuer is going to pay back the face value of the bond. So Morgan owns 15 bonds. The issuer is going to pay $1,000 times 15. So he's going to pay Morgan $15,000 at the end of 30 years. So if we add those 3 numbers, we can get the net gain for this particular investment. So the net gain is $22,812. So now to calculate his ROI, it's $22,812. That's his profit divided by the cost of investment times 100%. So his ROI for this particular investment is 144%, which is not that bad because he still made money, but nevertheless, it's not that high for a 30-year time frame. Now, before we end this problem, let's talk about how to calculate the yield to maturity. The yield to maturity is an annual return that you can expect from earning from the bond if you hold it to maturity. Now, the formula that you could use to estimate the yield to maturity is this formula. It's equal to C plus F minus P divided by N over F plus P divided by 2. So C is the interest payments that he's receiving. So in a 1-year time frame, he's going to receive, and I had that number too. I'm going to have to recalculate that number. It was 15,000 times 0.0525. So the interest payments is $787.50 on an annual basis. F is the face value. The total face value for this is 15,000 minus the price, which is 15,813. Now, granted, you can do this using these values. So if you want to use smaller numbers instead of using these larger numbers, we can do this. So assuming the face value is 100 instead of 1,000, C is going to be $5.25 if the face value was $100. F, the face value is 100. The price of the bond is 105.42. And then we're going to hold this for 30 years. And then this is going to be divided by F plus the price of the bond over 2. So if you were to use $1,000 for the face value, the premium would have to be $1,054.20. And then the coupon would have to be $52.50 because 5.25% of 1,000 is $52.50. But if we use a face value of 100, 5.25% of that is just $5.25. Now let's go ahead and plug these numbers in. 100 minus 105.42 divided by 30, that's negative 0.1806 repeating, and then add 5.25 to that. And so you get 5.0693 repeating on top. On the bottom, 100 plus 105.42, that's 205.42. Divide that by 2, you get 102.71. And then dividing those two numbers, and then we're going to multiply this by 100% to express the yield to maturity as a percentage. So the yield to maturity is approximately 4.9% according to this equation. So if Morgan were to hold the bond for 30 years, and if the municipality doesn't default on this bond, he can expect an annual return of 4.9% on his investment. Now let's move on to number 3. Karen buys 10 callable tax-free bonds at a discount of $98.50. So she's buying it less than 100, which is good. The coupon rate is 5, and the payment frequency is semi-annual. What is the total price of the 10 bonds? So it's going to be 10 times the value of each bond. Remember, one bond has a face value of 1,000, so we need to multiply this by 10. So the bonds that she's paying for is going to be $985. So her total investment is $9,850. So that's the total amount of money that she's going to pay for the 10 bonds. Now, part B, calculate the annual interest payments, not the semi-annual, but the annual interest payments Karen will receive. So the 10 bonds have a face value of $10,000 if you multiply 1,000 by 10. So the interest payments will be based on the total face value of these bonds. The coupon rate is 5%. So we're going to multiply this by 0.05. 5% of 10,000 is $500. So that's how much money that whoever the issuer is going to be paying Karen. Karen's going to receive $500 in interest payments each year, or $250 in semi-annual payments. So that's it for part B. Part C, what is the current yield of this bond? The most simplest way to calculate the current yield is to take the coupon rate, which is 5, and divide it by the current price of the bond. So that's $98.50 times 100%. And so the current yield is 5.076%. So now let's talk about this. Because Karen bought the tax-free bond at a discount of $98.50, her current yield is greater than the coupon yield. And so it's wise to buy a bond at a discount than at a premium, because your current yield will be greater than the coupon rate. Even though the annual interest payments won't change, the yield that you're getting relative to the amount that you paid for the bond, that can change. And so you want the current yield to be as high as possible. So now that we have the answer for part C, let's move on to the next situation. After 5 years, prevailing interest rates fall to 3%. The issuer exercises their right to buy back the bonds from Karen so that he can sell new bonds at a lower coupon rate. And that is at a coupon rate of 3. And that's one of the disadvantages of callable bonds. A callable bond gives the issuer the right to call back the bond. In order for them to do that, they have to pay Karen back the face value, not what she paid for, but the face value of the bond. Well, since she paid $985 for the bond, and she's going to receive $1,000 back, that's good news for her. But nevertheless, she's no longer going to receive a 5% interest on these bonds, because the issuer doesn't want to pay 5% interest for borrowing money when he can pay that debt back and then sell new bonds at a lower interest rate of 3%. He doesn't want to pay 5%, he prefers to pay 3%. And so that's one of the advantages of selling callable bonds. It benefits the issuer because if interest rates fall, they can buy back those bonds and sell new ones at a lower interest rate, which reduces their expenses. So what is Karen's ROI for holding the bond for 5 years? So if the bond is called back, she may not be able to hold it for 30 years. So in this case, she's only going to receive interest payments for 5 years. So her initial investment was $9,850. And she was receiving $500. Let me put this somewhere else. She received $500 per year in interest payments, and this is for 5 years. So 5 times 5 is 25. So she received a total of $2,500 in interest payments over the course of 5 years. Now, when the bond is called back, the issuer has to pay Karen $1,000 for every bond she owns. So since she owns 10 bonds, the issuer has to pay $10,000 back. So on the bonds, she has a capital gain of 150 plus the interest payments of 2,500. So her net gain is 2,650 on this investment. So now we can calculate her ROI. So if we take a gain of 2,650 divided by her initial cost of investment, which was 9,850 times 100%, this is going to be 2,650 divided by 9,850 times 100, and that is 26.9%. So that's her ROI after 5 years. Number 4, a bond is currently selling for $108 with a coupon rate of 7. What is the current yield of the bond? So the current yield is going to be the coupon rate of $7 divided by the price of the bond, which is $108, times 100%. And so that's going to be 6.481%. So that's the current yield of the bond. Now, part B, if interest rates rise to 10%, what will be the new bond price so that the annual coupon payments remain the same? Well, we know that when interest rates rise, bond prices fall. And the reverse is true. When interest rates fall, that is prevailing interest rates, bond prices rise in value. And this problem is going to illustrate that. So right now, we have a bond that's selling for $108 with a coupon or a current yield of 6.481%. The coupon rate doesn't change, but the current yield can change. So for a bond with a face value of 100, the payment will be $7. Now granted, the face value will be 1,000, which will yield a payment of 70, but let's use 100 just to keep things simple. Now, how can we determine what the new bond price will be if interest rates rise to 10%? Well, there's a simple formula that you can use to get the answer. B1 times R1 is equal to B2 times R2. So B1 is the original price of the bond, which is 108. R1 is going to be the current yield of that bond, which is 6.481%. And for this problem, you don't need to convert the percentage into a decimal. B2 is the price of the new bond, such that the coupon payments remain the same. R2 is going to be the new interest rate, which will be like the current yield. And that's going to be 10%. So it's 108 times 6.481 divided by 10. And so the new price is going to be $69.99 with an interest rate or a current yield of 10%. Now, notice that if you multiply 108 by 0.06481, you get a coupon payment of 7. But if you multiply 69.9948 times 10%, which is times 0.10, you get a coupon rate of approximately 7. It's really 6.99948, but it rounds to 7. So notice that if interest rates go up to 10%, the value of the bond goes down such that the coupon payments are the same. Now let's think about why this happens. Why does the value of a bond go down when prevailing interest rates go up? So imagine if Karen owns a bond offering her a current yield of 6.481%. And let's say that she paid $108 for that bond. So she's receiving a coupon of 7. If interest rates go up to 10%, a new investor, let's say John, he doesn't want to buy Karen's bond for this price. He doesn't want a yield of 6.481% when he can go buy a bond and get a yield for 10%. He wants a 10% yield. So if there's a bond out there, let's say that he can buy for $100 and get a 10% yield, he wants this bond. Now, the only way that John is going to buy this bond from Karen is if Karen lowers the price such that the amount of money that he's going to receive represents 10% of his investment. So if Karen lowers the price from 108 to approximately $70, then John will receive $7 of interest for every $70 that he invests in this bond. And so he's receiving the same effective rate as the bonds that are currently available in the market. So due to supply and demand and economic forces in play here, Karen will lower, if she wants to sell the bond, that is, she doesn't have to, but if she wants to sell it, she will have to lower the value of the bond until the current yield of the bond matches the prevailing interest rates that's in the market right now. So that's why the value of bond prices go down when interest rates go up. In order to sell the bond, Karen has to lower the price of the bond such that the current yield of that bond matches the interest rates that's at the market. So now you understand why there's an inverse relationship between interest rates and bond prices. Now let's move on to part C. If interest rates fall to 4%, what will be the new bond price given that annual coupon payments remain the same? So we saw the first example when interest rates rose. When the interest rate rose from 6.48% to 10%, the value of the bond decreased from 108 to approximately $70. Now in the second example, we're going to decrease the interest rate, so the value of the bond is going to go up. So let's use this formula again. So B1 is going to be 108, and R1 is going to stay the same, 6.481%. Now we're calculating B2 again, and the new interest rate is 4%. So B2 is going to be 108 times 6.481 divided by 4. So the new price, let's get rid of this. The new bond price will be $174.99 if you round it to nearest cent. And this is at an interest rate of 4%. So now let's talk about why the value of the bond went up when interest rates went down. So right now, John can go to the market and buy a bond for a price of $100 at a 4% interest. Or he can buy Karen's bond and get a 6.48% interest. Her bond is very valuable. John wants that 6.48% interest. That yield of 6.48%. He doesn't want a yield of 4% when he can get a yield of 6.48%. Now, Karen's bond is very valuable, and she's not going to sell it at this price, given that bonds are only paying 4%. She wants to hold on to this bond. So John, he needs to raise his offer price if he wants Karen to sell. And until he raised the price up to this point, Karen is not going to be interested in it. So John, if he wants to buy that bond, he has to increase the price up to this point. If he increases it to $174.99, with the coupon rate remaining 7, the current yield will be 4%. If you multiply 174.987 by 0.04, this will be approximately 7. And so that's the effect of decreasing the interest rates. The value of bond prices go up because investors, they will pay more for this bond because it's offering a higher yield. And as the bid goes up, the current yield will go down until it reaches a state of equilibrium where it's the same as the interest rates that are available in the market. So that's basically it for this video. For those of you who are interested in more stock-related content, bonds, and other investing topics, feel free to check out the links in the description section below. I'll be posting some videos there as well. So if you like this video, don't forget to comment, like, and subscribe. And thanks for watching. Hopefully this video gave you a good introduction into bonds and how they work and how bond prices are affected by interest rates, and also how to work the math behind these types of investments.